because man cannot live on bread alone. And so too can projects not survive purely on funds. You need that support, that ecosystem network backing that we seek to provide. So it's important to remember that Adaverse consists of those two aspects. And so that really taps into our investment strategy, which is early stage African blockchain projects. One thing we're very proud of at Adaverse is that we are active on the ground. We are Africa native, we are by extension crypto native, and we specialize in African projects. So to date, we've invested in 13 companies, the majority of which have been Nigerian, but we've also invested in South African, Cameroonian, Kenyan, and potentially Ghanaian projects in the future as well. So in terms of geography, Africa focused, but nationally agnostic, and also sector agnostic as well. So we've looked at prop tech, NFTs, exchanges and finance products, as well as sort of more general metaverse related startups and more. So we are flexible, we are open, provided that you are building on blockchain on the one hand and either based in or applicable to Africa on the other. And I think that's one thing that's actually really important, not only with respect to Adaverse, but the whole African blockchain space, is that you need flexibility, because one of the most exciting things, in my opinion at least, about blockchain in Africa is that it provides real solutions to real problems. And of course, problems in Africa, in Nigeria, are diverse, they're multifaceted, vary from region to region, country to country. And so with that, responses to them also need to be diverse and also need to be flexible. And that, I think, is one of the great benefits of blockchain in Africa as we see it today. So that's about Adaverse, and I think mentioning the Accelerator program in a bit more detail is also worth touching on as well. So not only do we invest, typically at earlier stage companies up to about Series A, but more commonly around seed stage in terms of growth, but as mentioned, we accelerate. So we're launching the first batch of accelerated companies later this month, or indeed early next. And typically it's tapping into those ecosystem contacts we have through the Cardano Foundation and through Everest Ventures Group, particularly providing token-related support and advisory services, to actually get your tokenomics correct, get them sorted, and build from the ground up, with a view over about 3 months and various sort of mentorship opportunities and one-to-one pairing to get companies to a, let's say, more mature stage in their business life cycle. So we like to draw on effectively all of these areas to provide a holistic package of support. But still, the question remains, how do you access that funding? Not just with respect to Adaverse, but with any investor. And I'm going to talk through a few points, I think, that are important for all founders to consider and have in the back of their mind when actually going out and reaching out to potential investors. And in doing so, I'm not going to sort of tell you how to build a company or how to start a company, although it may seem that a lot of areas overlap. I think it's more about presentation when attracting investment, because for better or for worse, when seeking out backers and partners, to a large extent it is presentation, it's marketing, it's how can I best express the platform that I've created or the company that I'm seeking to grow. So with that in mind, the first thing I would say when reaching out to any investor and presenting your idea is, what am I actually seeking to do? What problem am I seeking to solve? Because the nature of the blockchain, as we've mentioned, is it provides these sorts of these solutions directly to problems. What are the pain points I'm seeking to touch on? Because I have a lot of conversations with companies whereby they've got they're all-in-one solution, a super app is what they call themselves, and you've got GameFi on the one hand, you've got a metaverse project on the other, and they're also going to do a launch pad and exchange. And you ask them, you say, well, okay, in a sentence, what are you seeking to do? And they can't say. Because fundamentally, I think if you can't express in one line what your project is about, you probably need to rethink it. And I think the most effective projects are where investors, potential users, potential customers are able to easily understand it. Pick an issue and work on that issue, and then the rest will fall into place afterwards. So that's very important to consider. Don't try and do too much at once. And with that as well, I think, is also having in mind, who is your customer base? Who is your user base? Who is most relevant to your app? Is it B2B? Is it B2C? Is it B2G to government? Or indeed, is it C2C, as we see with a lot of peer-to-peer trading exchanges? And I think that once you have not only the pain point it's targeting, what you're actually seeking to do, but also the customer base in mind, things become a lot easier, because you can tailor subsequent business plans, subsequent financial forecasts and predictions to that customer base as a result. And again, when going to investors, it's much easier, I think, to actually paint a very clear picture of what it is you're trying to achieve from a business perspective. So once you've got that worked out, you also need to make very clear how the product actually works. So I'm talking from quite an Adaverse-centric perspective here. Convexity might be slightly different, but when we seek to invest in a company, we like to see an MVP. We like to see some initial traction. That is to say, how does the solution actually function? So for example, it's great to talk about, let's say, cross-border payment solutions or decentralized exchanges or an NFT marketplace. But the thing is, anyone and everyone can and indeed does talk about those solutions. But how does yours work? And indeed, can we see it work? Even if it's just a demonstration of the user interface, of the UI and the UX, it's always good to show investors how these things are tangibly manifested and tangibly actually work from the ground up. So show the demo, show the MVP, show how it works, and indeed I think go deep dive into the tech. Show actually what is it that I'm bringing that is novel, that is new, and brings about the solution in a way that Web 2 or current methods can't. Because again, as great as the brand story is, as great as the pitch deck and all the taglines, as well as they may work, if the actual solution, the MVP, isn't there, it's going to be very difficult, I think, to sell the idea to more serious investors, particularly international investors, who want to invest, let's say, higher ticket sizes or larger amounts of capital. So that's absolutely necessary. So let's say, for example, you've built the idea, you're on the way to developing the solution, you've got this MVP, and things are going really, really well. What about the team? Now, again, a lot of the conversations I have, particularly with earlier stage startups, they're with sole founders or maybe a pair of co-founders. And I think there is a lot of merit, and it's seen typically as very noble to build this on your own, to be the sole founder, and you're a young guy, you've built up this whole platform, one-man show, fantastic. But that's very difficult to scale. So of course, whilst you're dealing with a few hundred users and you're rolling out that MVP and you're working from the ground up, you can do it on your own. But if you're serious about your company and your platform and you want to see it grow, you want to see it expand, you want to emulate the success of Flutterwave, of Paystack, of Quidax, Chippercash, whatever, these aren't one-man shows. And indeed, if we look back to any of sort of the big names in entrepreneurship and startups, you look at the Mark Zuckerbergs, the Bill Gates, even Elon Musks of the world, none of them did it alone. You need to have a strong team behind you. You need a CTO in particular to deal with the technology side. A CMO, what's your go-to marketing strategy? And a COO, how do things work internally from an operational perspective? All of these bases need to be touched on such that as and when your platform does take off, it gains that traction, it gains that speed of development. Investors need to be sure that you'll be able to handle it. Because it's not easy, I think, scaling to mass market, particularly, let's say, across Africa, where those markets are diverse, there are different regulatory requirements, as has been touched on earlier, and indeed different market requirements. So there needs to be that basis there in terms of personnel. And I think an area that I'd like to mention that's actually little touched on, unfortunately, is co-founder synergy. So you founded a company solo, which is great, but you're looking for a co-founder, which is absolutely necessary. I think too little thought goes into picking that co-founder and being sure, 100% sure, that there is that synergy and you can work together. Because far too often in the startup space, particularly the blockchain space, you see fallings out, you see disillusionment between co-founders. And although that's unfortunate and people fall out all the time, when it comes to involve wallets, seed phrases, wallet addresses, even passwords to social media and email accounts, when they get caught up in the middle of let's say, a messy co-founder divorce, companies suffer as a result. And given the nature of encryption being central to blockchain and by extension crypto, if there's not total centralized control from the founder's perspective, and there are these two separate warring parties, things can go very wrong very quickly. So building a team is obviously very important, but I would say that making sure that co-founder who you're working with most closely is aligned to your views, to your goals and ambitions for the company is also absolutely fundamental. So you've got the team, you've got the product, and you know what that product does. So the MVP is there, and you're reaching out to investors. Now, as crude a point as it might be, and no one likes to talk about it directly, money talks fundamentally. If you're speaking with an investor, again, the concept might be fantastic. You might know exactly how it's going to work and who it's addressing. But the big question on everyone's minds is, well, how much money is it going to make, and indeed, how are you going to make that money? So there are two aspects there. The first of which is revenue streams, and the second of which is the volume that comes with those revenue streams. So let's say, for example, you're launching, again, a cross-border payment app, working on the blockchain, up and coming, low-hanging fruit almost, we might say, in terms of startup space. How are you going to make money off it? Is it going to be commission off transactions? Is it going to be a subscription fee? Are you going to launch an ICO? One of the beauties, I think, of blockchain-based startups is they are so diverse in terms of how you can monetize, how you can acquire that revenue, and how you can actually deep dive into all of these commercial aspects that they offer. But you need to be sure exactly how you're going to do it. And on that basis as well, you need to be able to offer predictions and projections. So as an investor, what I would really want to know in any company I'm looking to invest in is what are your returns going to be like? How much are you going to make in this period? And with that, how do those returns overlap with your user base? So we look at very important metrics, for example, such as cost of user acquisition, spend per user, and how then that scales with growth actually in the user base. These are all very important metrics, and I think ones that are very important to include, such that investors can get a very clear view of not only the value of the platform, but also the future growth of the platform, which is really what investors invest in. It's a bet, fundamentally, but a bet that needs to be informed. And I think, sort of going on from that as well, it overlaps, but is a slightly different point, is we've heard of KYC, KYV, but I'm going to mention a new KY, which is KYI, Know Your Investor. Because, as I mentioned at the beginning of my talk, man cannot live on bread alone. Funds only go so far. I mean, of course, everyone wants to be the company that can raise a $5 million seed round. It's great. But if you get swamped with $5 million to your seed stage company, the chances are you probably won't know what to do with most of it. I mean, if $5 million lands in your bank account, that's great, but what do you do with that money? You need to have strategic partners. You need to be aware of what you want to get from investors, what you expect from them, and indeed, by extension, what they will be expecting from you in return. So, for example, if you've got the product, you've got the revenue, things are going well, you don't want to give too much away because you can handle it internally, but you're missing contacts in the ecosystem, that's very important to consider. Because there's no point trying to go into business with a partner who you know full well isn't going to align with your values and your goals, and vice versa. So, for example, if you need a crypto-native VC or crypto-native investor, look for crypto-native VCs and crypto-native investors. Similarly, if you want to only deal with the domestic market, go for native VCs and native investors. If you want to expand internationally, let's say into Europe, then look for European VCs and European investors. And that's mutually beneficial for everyone involved, because what it will mean is that the conversations you have will be far more fruitful, because you know that your values are aligned. What they look at is in line with your company and your goals. And on that basis, you'll be able to far better get to the root questions, whether it be in terms of sort of company concept, projections, and future growth, far quicker than if, for example, you as a cross-border exchange app decide to speak to an agri-tech-based VC. It's not going to work. And I think that's also fundamental to consider. But despite what all I've said, I think an overarching point remains that is going to sound slightly contradictory, but I think is nonetheless important to consider, which is actually don't be too hasty when seeking investment. If anything, I would almost advise against seeking investment from the off. Because if you approach a potential investor, a VC, a fund, not an incubator per se, because I think actually this is what incubators do, and we'll get into that shortly, or an accelerator, and you've got no revenue, you've got no traction, you've got no MVP, the conversation is going to be very difficult. Because as great as the idea is, I mean, what does the investor look at? What do they go off? And how do we know from the investment perspective that this is going to be a success? And my advice always is, and I think this is actually relatively standard in the startup space, it's not a controversial view necessarily, is to bootstrap for as long as possible, for as long as you possibly can. Provide the use case in-house. If you're able to generate that revenue, generate those users, get the traction through the door, then absolutely do it. Because what you've also got to remember as well, and I hate to sell out my own kind in this way, is that investors are devious. There's no such thing as a free lunch. They always want something in return, whether it be equity, whether it be debt investment, for example, or token allocation. There's give and there's take, which works very well in the right sort of partnership. But if you can bootstrap and you can continue to grow without that give, it works again better for everyone. So, there are a lot of guys I speak to, early stage founders. They're at pre-seed stage and they're desperate to raise millions of dollars. And I understand why, right? And I'm sure in some ways that would help, but it's not the best thing for the growth of the business. There needs to be that organic growth. I think there also needs to be development from the company itself to not only learn what works and what doesn't, but also get themselves into a stage whereby they can be 100% sure as and when they do come seek investment, what investment they need, what partners they need, and how they can sort of go about getting that as a result. So I guess approached holistically, slow and steady is the way to go about these things. I think being very self-aware with respect to, being very self-aware with respect to what you do as a company, what you're looking for as a company, and also how you want to grow as a company is fundamental. And just as I begin to wrap up, I think it's also worth considering what investment really means, right? Because I think we're in a great spot actually to go into that, because Convexity is an incubator, as we all know. Adaverse is an accelerator, and then we've also already heard mentioned earlier today, traditional family offices, VC funds, in pure investors. And I think one of the mistakes that founders often make is they assume that investment just means money, it just means lump sums of cash, when in reality the picture is far more multifaceted. So you can begin with incubation, you can move on to acceleration, and then you can seek investment as we typically understand it. And I think that's very important to remember as well. You don't just want to receive, as I've said a couple of times before, those lump sums of cash into your wallet, because it's not going to help you grow and scale your business. And again, touching on that as a last point, and almost, I guess, an appendix, are tokens. As Ola mentioned before and has been touched on, I think in various conversations that have happened today, not all projects need a token. So when you're looking at, for example, methods of investment or acceleration, incubation, etc., don't be obsessed by the idea of a token. There are many platforms being founded, seed, well, pre-seed, seed, up to Series A really, obsessed with the idea of a token. I've got to ICO, I've got to release a token. I've got a 100 billion market cap, and they're all going to be priced as $1. It's going to make loads of money. Fantastic. It's not necessary. I mean, it works in some cases, but it's not always necessary. Don't lead with the token. Don't pump and dump, basically, because I think that, if this was 2018, we're having this conversation, I'd say, great, go for it. 170 million, no problem. Easy money. Not anymore. And it will harm you, it will harm investors, and I think it harms the ecosystem as a whole. So don't look at tokens as a quick fix, basically, whether it be with respect to revenue or crypto as an idea. Because something we also have to remember as well is that blockchain is not crypto and crypto is not blockchain. There's a lot more to blockchain as a technology. And I think the sooner people begin to appreciate that from a founder's perspective, the quicker this space will grow. I don't want to take up too much more time because I'm aware there's more speakers to come, and I've bored you for long enough. But I mean, as before, slow and steady wins the race, I think, when it comes to investment. Purposeful choices are very important. And any further questions, I mean, I look forward to touching base in more detail with everyone after sort of the event formally concludes. But do just let me know, and we can keep in contact from there. But I hope it's been some help, and thank you for everyone for listening. Much appreciated. Thanks.
Thank you so much, Mr. Willam. So I would like to introduce Mr. Ayo Akim. Welcome, Mr. Akim.
Mr. Ayo, 50 minutes, please try to make it as brief as possible.
How many minutes do I have?
15.
Okay. You ready? Yeah. Starts from here. Starts from here. Yes, starts from here. It's on. Okay, good afternoon all. I believe you can hear me. Yes.
Hello?
Have you switched it? The mic isn't working.
Hello?
Yeah, thank you very much. Looks like it's been a long day, so I'll make this as fast as possible. We're going to be talking about tax. Like someone said, there are two things that are certain in life. One is death, the other one is tax. So everybody needs to be involved in it. My name is Ayo Akinduite. I'm an associate director with PwC. Just a few things around startups. So when I was told that I'm going to be talking about startups, but incidentally, my colleague has covered something similar to this. So the only other thing I would just like to mention here, I don't know what is your motive, in terms of starting off your business. Is it because you want someone to buy you off in future? And that's a fantastic idea. We've seen quite a number of startups that have made success out of that. So taking care of your tax responsibilities, taking good care of your legal and regulatory requirements could put you in a very good position when investors are looking at you as a potential acquisition. One of the things they will look out for is how well you have managed your affairs. And the way to test that is how well have you complied with the tax requirements in your country. The last thing any investor wants to do is to acquire a company that then brings tax exposure. Then needs to start going to court and all that. So if this is one of your objectives, then please pay attention to this conversation. So let's start off with what taxes are. Taxes generally charges or expenses that you incur on the basis of law. So it's not just somebody's intuition. The law is very specific. If you do this kind of activity, if you make money, then you've got to contribute to the welfare of the society. And broadly, there are two categories of taxes. You have the taxes that arise by virtue of the fact that you make profit, so which is called income taxes. So many of us that are startups, maybe at the earlier stages of your entity, you may not need to worry so much about this because it's based on the fact that you have made profit. So at the beginning, except in very few instances, the first few years of most businesses, they will make losses. And the good thing is those losses, you can carry them forward and you'll be able to relieve them in future when you become profitable. What does that mean? That means that when you start making profit, the losses that you have incurred in your earlier years, you can go to the taxman and say, yes, now in the last 2-3 years, I've made losses of about 10 million naira. But this year, fortunately, I make profit of 100 million naira. Now I can take the losses of 20 million and use it to offset my profit. So only 80 million out of the profit will be exposed to tax. That's supposed to be some kind of incentive. The other type of tax, which is applicable even if you are a startup, is transaction taxes. And that is driven by the fact that you are involved in certain transactions. You buy certain items and there are taxes related to those items that you would have to pay for. A very good example that I believe many of us are very familiar with is value-added tax. So transaction taxes will be applicable to you. So a few things from a regulatory point of view. As a company, you need to register for tax. Then you have your tax identification number, and that is basically what then drives all the things that you do with respect to your entity. The benefit of having this is, at a glance, the tax authority can see your performance, can see your historical view, and they'll be able to ascertain the fact that you are compliant with the law as regards taxes. And there are a couple of other items also. For example, if you have up to 3 staffs, then you need to register with PENCOM. So these are things that you need to pay attention to. So it's not just the big tax number. I need to register with the Federal Inland Revenue Service, the other agencies also, depending on the kind of activities you do, the scale of activities you do, then for you to be fully compliant from a regulatory point of view. So I'll just run through a few tax types. and some of the things that you need to pay attention to. Company income tax is an income tax. You recall I said there are two broad categories of taxes: income taxes and transaction taxes. So income tax, most organizations, if you register a company, it would have to pay company income tax. The tax rate is 30% broadly, but for small companies, and I believe many of the startups may fall into the category of small company, from a tax point of view, a small company is a company with turnover not less than 25 million. So those businesses will not pay taxes. So it's a good thing for you to register with the tax